The S&P 500 finished higher today. Do not trust it. That small green number is the least honest thing the market printed all session, and I can show you exactly why. Sitting underneath it, the Nasdaq dropped more than 1%, and the chip group shed 4.5%. The dealer hedging flow that runs beneath the index swung from $4 billion of buying to $4 billion of selling, and closed the day net negative. So, nobody was actually buying the index. The plus sign came from somewhere else. Money stood up out of the mega caps and sat back down in the Dow, which added almost 0.5%, while small caps and technology walked the other way. That is not buyers arriving. That is money changing seats. This is the Algo Index market close for Friday, July 24th. Let me show you the trade behind the calm. Everything ahead comes back to a single question the chart cannot answer for you. Was today real rotation into value, or just technology money hiding for a week? The hedging data has a view. The biggest options bet on the board has a view. And next week's volatility is quietly telling on itself. We will get to all three. Here is where the numbers landed. The S&P 500 closed near 7,413, higher by a rounding error. The Nasdaq gave up 1.2%, semiconductors 4.4, and the Dow rose 44 hundredths, while small caps slipped 1/3%. Volatility eased a touch, with the fear index at 18.5, yet its own volatility gauge held near 100, which is elevated. The whole day covered less than 0.9% of range. Put and call open interest leaned protective at 1.19, and implied volatility rank sat around 1/3, neither cheap nor rich. The one-line read, the index was quiet. Its insides were anything but. Three forces, and every one of them has a number. First, leadership came apart in exactly one place. Semiconductors fell 4.4%, and a single mega-cap electric vehicle name accounted for roughly 83% of the day's negative single-stock hedging flow through longer-dated put buying. Point the same lens the other way, and you find a large enterprise software name rebounding about 7% off a dealer hedging shelf on longer-dated call demand. That is the rotation in one frame. One giant being sold, another being bought. Second, the flow. Real-time dealer hedging opened the day near $4 billion long, drained to $4 billion short by mid-afternoon, and settled around $1.5 billion negative, driven by longer-dated call selling and short-dated put selling. Dealers are now net short gamma, which means their hedging stops cushioning moves and starts chasing them once price slips below the 7,400 line. Third, the arithmetic of the close. The index printed green not because anyone stepped in for it, but because the Dow going up and technology going down canceled to almost nothing at the cap-weighted level. A flat number sitting on top of a violent internal split. That is dispersion, and it is the whole story of this session. Walk the real path with me. The cash index opened more 7,406, ground higher into a noon high of 7,461, and stalled there to the tick, because 7,460 is the first dealer resistance shelf. From noon, it bled lower all afternoon to a 3:30 low of 7,396, poked just beneath 7,400, then reclaimed it into the bell to close near 7,413. That 7,400 line is the one that matters, and we have circled it for days. It is the level where dealer hedging flips from stabilizer to accelerant. This afternoon, the market went and touched the underside of it, then closed back above. Clean map for next week. Resistance at 7,460 and the 7,480 pivot. Support at 7,400, and beneath that, 7,300. The loudest options position of the day was a bet on nothing. Someone put on a same-day iron condor, selling the 7,470 strikes up top and the 7,345 strikes down below, effectively selling the entire day's range in one structure. On a session when the mega caps were cracking, the single biggest structural bet was that the index itself would go nowhere. And it worked. The market closed at 7,413, sitting dead center between those wings, and the range sellers kept every dollar of it. When the surface is calm and the insides are chaos, that is the trade that pays. Now, the part I think is worth the whole video. Into the weekend, protection actually got cheaper. Fixed strike implied volatility came off by roughly 1 to 3 points across the curve. On its own, that reads like calm. But look 1 week out, and the story inverts. Front week implied volatility for next Wednesday's rate decision is priced around 13.5%, and for Thursday's inflation print, around 15%. The forward volatility the curve assigns to those exact same dates is far higher, near 20 and near 22. That gap is the market underpricing its own event risk. Read it plainly. With a central bank decision, quarterly growth, monthly inflation, and 4 of the largest companies on the planet all reporting inside 5 days, the options market is carrying less protection than the forward curve says those days are worth. Put and call open interest at 1.19 leans defensive without panic, and volatility rank near a third is middle of the road. So cheap protection tonight cuts 2 ways, and I will not pretend one calm Friday settles which. Here is the one thing today genuinely does not settle: whether the rotation into value is real conviction, or technology holders simply parking cash for a week until their own names report. You cannot grade that from a single session, and anyone who claims to is guessing. Our desk took 3 trades and closed all 3 at our chart level targets. 1 discretionary short into a failed bounce, and 2 on the automated side. Single leg, defined risk, every one. One of those positions round-tripped from deeply underwater back to near flat, and we chose to bank it rather than press, on an afternoon when 2 green trades were already in the book. We also passed on several setups that never cleared our quality bar, because forcing a trade into afternoon chop is how good sessions turn bad. Being honest about it, these are level reads, not a promise on any single options dollar result. Process ahead of prediction every day. And the thing I would watch on Monday is simple. Can this index hold green a second day without technology? Or does the rotation run out of seats? The lean into Monday is neutral, with a cautious tilt as long as the market trades below the 7,480 pivot. Monday itself is quiet. Durable goods before the open, forecast plus 1.5% against a prior minus 4.5%. 2 treasury auctions during the day, and no mega cap earnings. The week is where the weight sits. Wednesday brings the central bank decision, then Microsoft and Meta after the close. Thursday brings growth, inflation, and Apple and Amazon. The Bank of Japan closes the week on Friday. The map to trade against: resistance at 7,460 and the 7,480 pivot. Support at the 7,400 line and then 7,300. The 1-year high sits about 3.5% overhead, and momentum is soft rather than washed out. A reclaim of 7,480 flips the read constructive. A decisive loss of 7,400 hands the market to the sellers, with dealers net short gamma. What would move the bias early is the durable goods number, or any weekend headline out of the Middle East, where crude just handed back 3% of Thursday's spike. If you want to put tonight's work to use, 3 quick things. Our AI trading journal is free at members.algoindex.com/auth/signup, and it grades your entries against the levels that were genuinely live the minute you traded. Our gamma level accuracy tool lives at algoindex.com/tools/gamma-level-accuracy, and that record stays out in the open no matter how it makes us look. The full written breakdown is on the blog at algoindex.com/blog, and the trading community talks all of this through on Discord. The index printed green today, and its own engine printed red. Monday tells us whether the money that changed seats plans to stay in them.